Hey guys, Whitney here. Welcome to our masterclass today. We are going to talk about how the 1% grow their wealth. And so if you haven't joined us for one of our boot camps, monthly skill building boot camps, welcome. Again, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. And make sure to check out PassiveInvestingWithWhitney.com to get access to all of our masterclasses and skill building boot camps, as well as to see our open deals. Now, today is a little bit different than our weekly masterclasses. Today is meant to be an interactive session for you to ask any question that you have over the material that we cover. We're going to dive in. I want you to walk away from this skill building knowing how to use the principles that we introduce here to you. Now, if you've been with us at Passive Investing for quite a while, these concepts probably are not new to you. These are things that I wholeheartedly believe in and I'm constantly talking about. But if this is your first time joining us, take notes. So if this is the first time we're meeting, again, my name is Whitney Elkins-Hutten. I'm the Director of Investor Education here at PassiveInvesting.com. And this is the whole reason why I love real estate. I love active real estate. I love passive real estate. I started off in real estate in 2002, completely by accident. Started off living, flipping, and house hacking. Did really well at growing equity, are really bad at growing cash flow. I had no idea that cash flow even existed back then. And then one day, a friend of mine said, "Hey, why don't you keep one of those flips you're doing and put a renter in it and generate some cash flow?" And I'm like, "Oh my gosh, you're brilliant." And so my husband and I scaled 36 single family rentals, then eventually bought an apartment building in partnership. And that's really where the light turned on for us. We were like, wait, hold on. We can actually unhook our value we create in the world from the time it takes to do that. Like, we need to double down on this real estate thing, but do we do it actively or passively? Well, if you know me, I did it both ways. Dove into active and passive real estate. And, today I have, fast forward, I have over 6,500 residential units, 2,200 self-storage units, and 15 express car washes, all in partnership. There are some that are, my husband and I control ourselves, some units in there that we can control ourselves, but really, this is vanity metrics. What it is allowed us to do is control 100% in choice of freedom of our time. During the same time period of building this portfolio, I've also had the unfortunate experience of actually settling 3 probates, 2 trusts that have accumulated to over $700,000 of losses in poor planning. Okay, so that's pretty painful experience too. And this really prompted me to write my new book, Money for Tomorrow: How to Build and Protect Generational Wealth, because when I started talking to friends and family, I started talking to other investors, my experience was not new. This was happening over and over and over again. Okay. And when you take that loss and you compound it at 7% over 30 years, that's a pretty staggering loss to the next generation. Now, here's the thing. As you move through building and scaling your wealth, at some point in time, as an investor, especially a passive investor, as an investor in real estate, you're going to probably feel a little insecure about your plan. Okay. That's the pain that we all secretly feel. And that is a symptom that we have built skills in just a couple areas of wealth building, but in not all 4 core areas of wealth building. I'm going to get to that. So again, that root problem is that we have not actually been taught to master the game of wealth. We've been taught to chase tactics. And that is something that I'm going to really help you demystify today. And again, I want to remind you, you're not alone. These emotions that I have up here, I feel I make money, but I'm broke. I think about my finances all the time. I just don't have clarity. I hate talking about finances. I haven't defined what enough looks like. These are all things that when I speak to investors, these emotions come out on the calls. Okay. So if we're focused on the wealth game and how to win it, we have to do 3 things. Anytime you learn a game, you have to know the objective of the game. You have to know the rules of the game, and then you have to master how to play successfully. Nowhere do you open up the board of Monopoly and it just says, buy a house, buy a hotel. That's not where you start. We got to go back to the beginning. We got to cover the basics, the objective, the rules, and then learn those principles that'll help us win the game. So we've been touching on several things over the past few months that tie into this, and I want to do a quick little recap. The objective of the generational wealth game is to have enough passive income that covers all of your desired living expenses so you can do what you want when you want, okay? And to win the generational part of wealth, you want the next generation to be able to build upon what you created. They need to not, maybe they have the financial, bank accounts, they most certainly have to have the mindset and the skills and the network that you've built, okay? The rules of the game are pretty simple. I didn't say easy, simple. So now that we understand the objective, there's 4 rules you have to master. You have to be able to create wealth in your sleep, keep your wealth, grow your wealth, and then pass it on. Here's the thing. Most investors, remember at the beginning, we said most investors at some point in time feel a little hesitant, unclear, nervous, maybe even, broke at some point in time in their wealth building journey. And it's because investors, guilty as charged, learn to over-concentrate on creating wealth and growing it, not necessarily keeping it and learning how to pass it on. Here's the thing. If you don't learn to master these skills, okay, how can your wealth actually work for you? All right. Now, I want to get into the meat of today's webinar, but as always, I need to say today's webinar is for educational purposes only. What we cover today is not financial, legal, or tax advice, so make sure to consult with your team before making any major investment decision. Now, I wanted to kind of, we have to, especially as investors, right? Most investors, they build 2 huge skill sets, the create wealth and grow wealth. And they underdevelop the skill sets of learning how to keep it and pass it on. Today, we are going to dive into create wealth a little bit and then also growing the wealth, right? So if you're like going, Whitney, wait a second, you said I need to learn how to keep it and pass it on. The keeping part we spoke about last month in our boot camp, and you can go back to passiveinvesting.com, and dot is spelled out D-O-T on our YouTube page, and you can find that boot camp. So when we talk about that rule of creating wealth, we have to learn how to do 3 things very clearly. You have to have a plan, clear path to win. You have to know your income and balance sheet, meaning if you're not tracking, tracking your income and expenses, tracking your portfolio, and we're going to talk about tracking your portfolio next month in our boot camp, okay? It's going to be really unclear on if you're winning the wealth game or not, okay? And you have to align your spending habits so you always win. Now, for today, I'm just going to recap the balance sheet, what it is we're trying to do here, okay? So the balance sheet of the poor, essentially you got a job, you bring in your income, it covers your expenses. You have no assets, okay? You have no liabilities, probably even. As we get into the middle class, we start buying cars, going to school, taking out loans for school, maybe we contribute to a retirement account or something like that. We start accruing, maybe paper assets, maybe no assets at all yet, but we start accruing liabilities. And those liabilities have expenses attached to them, right? For us to be able to be truly wealthy, we have to learn how to build this bucket of assets so it covers the income that it kicks off, covers our all of our needs, okay? It covers all of our expenses and it covers all the liabilities attached to those assets. So your real estate might have mortgages attached to it. If you're a passive investor, your multifamily or self-storage project has a loan attached to it. Your express car wash has a loan attached to it. But the real estate brings in enough income to cover the liability and kick off additional income for you, all right? Now, the reason why we have to understand that balance sheet, how that works, is because it really impacts our ability to grow. If we go back here and our assets are not bringing in enough income to cover their liabilities, we're back into a middle class balance sheet pretty quickly, Okay, so we have to learn how to make sure that when we're evaluating assets, that they are covering, the assets are at least covering their own liabilities. I work, one-on-one with a lot of, investors that have built, say, like a single family rental portfolio. And sometimes they get themselves in a situation where they buy all these A-class properties and they're feeding the property cash. The property is not even bringing in enough income to cover expenses, and that puts them in an upside down position. Okay. Now that we kind of mastered that concept, let's go to the growing wealth concept, because this is where I want to spend bulk of our time here today. And in order to grow wealth, we have to be able to do two things very well. Okay, one, we have to be able to master the 7 pillars of wealth. Okay, and that is what I want to impart to you today. And then we have to understand what assets actually kick off these 7 pillars of wealth. Okay, there's not everything that you could invest in out there actually adhere to the 7 pillars of wealth building. Okay, so when we take the 7 pillars of wealth building, we can divide them into 2 categories. The first 4 are what I call the 4 tenets of conservative investing. Every investment you go into should adhere to one of the, have these 4 tenets to it. Okay, now remind you, I said 4 tenets of conservative investing. All right, I'll make a distinction here in a minute. The other 3 are going to be amplifiers, things that you should have if you want to build true wealth, but they're meant to throw gas on the fire and help you build quicker. Right? So let's cover the 4 tenets, and we'll deep dive into each one of these tenets too. So the 4 tenets are learning how to invest in assets that preserve capital. Okay? We don't want to get knocked out of the game. We want our money to be safe. Number 2, that they kick off cash flow. Okay? In today's market, cash flow is compressed in a lot of asset classes, but we want cash flow to be there to where we're not feeding the asset, right? Again, we want the asset to be able to pay for itself, even if we're just taking a little bit of minutia cash flow. The asset needs to be able to pay for itself. We want to be able to take advantage of equity growth, okay, natural equity growth, forced equity growth, and also, like, if in the case of single family rentals, if you have a 30-year fixed loan on it, can you get paid down? Can you actually get principal paid down to the balance of the loan? That creates equity for you. And then we want to take advantage of tax benefits. Again, these are the 4 tenets of conservative investing. So when I am creating my chart and I'm looking at an investment, for me, I want to have all 4 of these pillars there in every single investment that I do. Okay, that's where I'm at in my investing journey. Let's pick these apart a little bit further though. Okay, just because you said, okay, Whitney, I wanted to preserve capital, what does that actually mean? Okay, so if we take our buddy Warren Buffett here, his rule number 1 of investing is never lose money. Rule number 2, don't forget rule number 1. Okay, so how do we do that? Well, for starters, we want to invest in an asset that's in investments that are secured by a hard asset. Okay, if something went wrong with the investment, we could actually take the asset and take it over ourselves and dispose of it and recoup part of our capital. Okay, that's one way. It's one of the reasons why I don't like stock bonds and mutual funds. Just going to say that out loud, guys, because I can't take over the asset. Okay, that perceived liquidity though makes me feel like I'm in control and able to preserve my capital, but I can't do anything about taking over the business and running it myself. Valuation of the asset. I want the valuation of the asset to be valued where I can impact it. Okay, or the operator you invest with can impact it. Okay, that they had the ability to grow the net operating income and increase the value, or the expected gross income of the asset and increase the value. It does mean that we don't necessarily want to overpay for assets. Okay, so whatever asset you go into, you want to see in the market that there's at least one other asset that's valued higher than your asset. Okay, that the market will support that higher valuation that you're trying to achieve. And we want to make sure that reserves are maintained on the asset, both for CapEx and operational reserves. Okay, this is how we're going to maintain capital here. All right. Conservative tenet number 2, cash flow. All right, we want to make sure that our assets are in a cash flowing position. Okay. So there's several different ways to do it, several things to look out for. So cash flow, I would like to invest in an asset that has multiple ways of generating cash flow, not just one. Okay. A friend of mine, Ryan Lee, used to be with Cash Flow Tactics. He told this amazing story. If you could invest in a forest, say like loblolly pines, you would have to wait for that forest to mature for 20 years, and then you cut it down, and then you get one big payday. Okay. The whole entire time, you're hoping that some sort of pestilence didn't come through, or the trees didn't get diseased, or a forest fire didn't rip through the area and take out your potential investment. He equated that loblolly pine investment to developments. Okay. So while you don't have any cash flow, but you're at risk, okay, higher risk, potentially higher reward, a lot more things that can come into play to actually change the outcome of that investment. Whereas if you invested in an apple tree, okay, it might take a little bit of time for that apple tree to be beginning to produce cash flow, but there's multiple units of a cash flow. I get hundreds of apples off that tree. Okay. Now, I have an apple tree in my backyard. Every once in a while, I get an early storm, and that, takes out half the buds on the apple tree. It's not that this type of investment or the apple tree won't experience issues, but I still should get some cash flow off of it. I mean, the reason why I'm more secure is because I have multiple units of cash flow. I want to have a clear plan to increase that cash flow. We're going to talk about NOI levers here in a second, but I want to have a clear plan. I want that operator to have a clear plan to build the cash flow. I want to make sure it has a low break-even number, meaning like when I look at all of my expenses on the property, okay, operational expenses, I want to make sure that and a lot of times, guys, debt is not figured into operational expenses. Okay, it's considered a below the line expense, not an above the line expense. Okay, so that's an important differentiator to ask whenever you're reviewing properties. But I want a low break-even number. Like I want to have the expenses as low as I possibly can, but yet still give great value in the market. Okay, that way if my income does fluctuate, I can potentially drop, that income can fluctuate and still cover and keep the asset. Just like preserving capital, I want to make sure that there are strong reserves on the project. And I want to make sure the lending on the project is smart, that it matches the business plan of the asset. Okay, equity growth and plus levers. All right, there's 3 different ways that we can tap into equity growth here. One, there's natural market appreciation. Okay, this is where you want to be in growth markets. You want to be in the path of progress, and you want to make sure that there's some sort of room to grow in that market. So if you go into a market and you're investing in a multifamily building and you say, I think I can raise the rents per unit $500, does the market already have an example proving that you can achieve that rent in the market? Okay, you want to make sure that there's room to grow, but there's always already an example there in the market that's been proven. Forced depreciation. Okay. This is where I actually take the asset and I can either increase the income of the asset, meaning I'm raising rents in some form or fashion, or I'm decreasing the expenses, whatever it is, I'm creating more net operating income there, or I can actually add additional streams of income. In the case of multifamily, maybe that's bringing, an expense like the internet bill, providing internet at the actual property. Okay, that means that instead of them paying Comcast or Xfinity, you're providing fiber internet, and you're getting that money on your profit and loss statement. Maybe you add in washing machines into the units, and you're able to get $50 more a unit, or you can do pet fees. Something like that. Charge an amenity fee because now you have a beautiful pool and a weight center, right? You're able to add additional streams of income to the property. And a third way, and this is really more for kind of controlled type real estate, you buying your own single family rental, small multifamily yourself, is that you can probably get a loan where you're outsourcing the debt. So In all cases, I should say, you're outsourcing the debt. We want to make sure the debt's covered, but you can even get principal pay down. And that's going to be typical for on assets where there's a longer hold period. Okay, that's another way to get equity growth. Now, we're on our last of the 4 core tenets or 4 core pillars for building wealth, and that is tax benefits. So we want to make sure that we're investing in assets where we can take advantage of writing off business expenses. And one of the largest business expenses out there is depreciation. Okay, now we can take inline depreciation, meaning we're just taking what's say like you have a $1 million building, 800,000 of it is attributed to the building. Okay, 200,000 to the land. 800,000, divide that by 27.5 years for multifamily real estate. That's inline depreciation. But what we like, investors like, the 1% like, is being able to do a cost segregation analysis on the property where you break that building apart into all of its different components, because some of those components break down in, say, 5 years, some in 15, some in 20 years. And anything that can be broken down in 20 years or less, we're fast forwarding our ability to take that depreciation to the first 5 years of the project. Okay. And that's how we're leveraging tax benefits in order to help us shelter income, not only within that investment itself, but if you have multiple passive investments, shelter the income across other passive investments. Okay. Or those losses stay on your tax return for future investment income. Okay. Another tax benefit is being able to leverage entities. Okay. And, this can be with real estate, this can be with businesses, but, can you use entities in order to lower your tax liability? Now, this could be as simple as like having an LLC and checking it as an S Corp or a limited partnership. Those type of entities are taxed differently. Their income has a different tax structure to it. Can you take advantage of incentives and credits? Okay. One major credit that's been out there, or incentive, has been bonus depreciation. Now, it's been ticking down. We're now in the year of 60% bonus depreciation, but that's still an amazing incentive for real estate investors to take advantage of. Okay. And that means that whatever you accrued in your cost segregation analysis, you get to take 60% of that in year 1. So go back to our $1 million building. We have $800,000 attributed to the, $1 million transaction, $800,000 attributed to the project, the multifamily building. We found through our cost segregation analysis that 600,000 of that could be, or I should have done the math easy for myself. 500,000 could have been accelerated to the first 5 years of the project, meaning I could have taken 100,000 in year 1, 2, 3, 4, and 5. But with bonus depreciation, I actually get to take 60% of that 500,000 in year 1. Okay. So that's how kind of these incentives work. And then also the ability to perform 1031 exchanges. Now, remember at the beginning, I said we need to understand the objective, the rules, and the underlying strategies on how to play the game. Here's where investors get lost, is that they are like, I want to invest in an opportunity zone or a Delaware statutory trust, or I have to do a 1031 exchange. These are all tactics. We need to understand the actual strategy on what the tactic is trying to help us achieve. All right. So those are the 4 core. So if you want to invest like the 1%, like the wealthy do, master not only creating the wealth, but also the rules, the strategies that will help you grow your wealth. Okay. The wealthy generally are looking for assets in their core portfolio that adhere to those 4 pillars. And then they're looking for ways to take advantage of other things in the environment. Okay. These other amplifiers, like leverage, like lending, like inflation hedging, and like investing with other operators outside of themselves in order to diversify and expand their portfolio. Now, we talked about the 7 pillars. Now we need to understand that there's only 3 assets out there that actually meet all 7 of these pillars. Okay. And that is life insurance, whole life insurance, okay, which we don't get into very often on the show. We do have a few webinars. We most recently had Rod Zembrowski with Money Insights on back in April. You can find that on our YouTube page. We've had other providers on here as well. Real estate, one of our loves, one of our favorites, and then businesses, okay? You can invest in businesses, okay? You can build your own business too. Here's the cool thing. When you invest in a syndicated deal, you're actually investing in a business that owns real estate. So you can get kind of the combination of these worlds pulled together. And then, if you've paid attention to any of our whole life insurance policy videos, then you can supercharge that a little bit by using your whole life policy to invest in the business that owns real estate. So again, you get some amplification here. Now, I want to take just a quick moment and show you just how kind of impact, okay? Like, how does the pillars play out? And quite simply, I have a spreadsheet. And like I said, we're going to go through tracking, in our next webinar, next bootcamp webinar. But in my tracking sheet, like when I'm looking at an investment, I'm making sure to grade it according to the 7 pillars. I get a little more nuance than yeses and nos. And then also the accelerators, inflation hedging, leverage. I also always vet the operator. Now I'm getting into my vetting criteria. But I'm looking to invest in assets that adhere to multiple pillars. Why is that? Because they tend to experience less volatility. Even though we've had volatility in the real estate market in the past 12 to 24 months, that volatility has been less than what we've seen in other assets, like paper assets, like cryptocurrency, like gold, and like cash. Okay. So, anyways, this is just kind of a quick, little snapshot to help you understand volatility. Now, I put together this grid back a little over a year ago, whenever our inflation year over year was 8.5%. Okay, we're down to about 3, but still there's a heavy delta here in these assets. Okay, and as you can see, I can get paid multiple ways at the same time. Now, the reason why I bring this up is because there's a mathematical formula that people need to understand, okay? Is that if I invest in assets that don't have 7 pillars of wealth attached to them, or even the 4 core pillars, and I'm only in an asset that kicks off 1 or 2 pillars, I probably have some sort of opportunity cost that is developing there in my portfolio. And I'm not going to dive too deep on opportunity costs here. We'll do a separate webinar, but I wanted to make sure to put this calculation in front of you, is that opportunity cost is a huge, huge erosion of wealth in your portfolio. And here's the thing. The wealthy, they know this. They look to lower the opportunity cost in their portfolio as much as possible. So this is just simple mechanics. Say you had an opportunity that yielded 10%, but you're sitting in another opportunity, like a bank account that's only yielding 2%. Okay, if your opportunity cost is 10% and you're sitting in something that is 2%, say like a bank account, that opportunity cost is 8%. Now, for example, if you invested $100,000 in our real estate debt fund, okay, no lockup on that fund, I'm just using it as an example, that's a 10%, you could get up to a 10% preferred return. Okay, not on the $100,000, you would have to be in a million, but hang with me here. You would have a delta here of 8%. Okay, and let's just say you had $100,000 and that delta was 8%. Now you got $8,000 of opportunity costs, money that you lost in year 1. Okay, so what is the opportunity cost of the investment? Is it really 8%? No, you've got to compound that $8,000 loss at 10% over 29 additional years. So that one choice, impacted your future by $126,904. Now, guys, that's the math I totally understand there's more emotion to this. There's more to it than just the math, but I want to put the math in front of you. Okay. Guys, I teach more of these concepts in my book, Money for Tomorrow. You can grab your copy here at biggerpockets.com /Whitney or /money for tomorrow. If you grab your copy on Bigger Pockets, there's you get access to additional masterclasses with me. They've all been recorded and additional valuable tools. And as always, if you're wanting to deep dive into more of these concepts, make sure that you're on our have signed up at passiveinvestingwithwhitney.com. Again, you get access to our masterclass sessions and our boot camps and access to our priority deals.